Good afternoon, students. Welcome to next lecture in the series. We are already started with ratios. Let us move towards the next category of ratios in today's lecture. Today we are about to study profitability ratios. You must have seen in the previous lectures in classification that how important profitability ratios are, and we do have a number of ratios here. We will divide them in two categories and then we will study. Okay, since the time you are studying business, it has been actually the main motive is the profit. So every business should earn sufficient profits to survive and grow over a long period of time. In fact, efficiency of a business is measured in terms of profit. If a business is profitable, it is termed as successful. So profitability ratios are calculated to measure the efficiency of a business, and we will be doing it in two ways. First is the profitability in relation to sales, and the other is profitability in relation to investment. Profitability in relation to sales indicates the amount of profit per rupee of sales. Similarly, profitability in relation to investment indicates the amount of profit per rupee which is invested in assets. Means that if a company is not able to earn satisfactory return on investment, it will not be able to pay the reasonable return to its investors, and the survival of the company would be threatened, obviously. So it is very necessary to know the situation, the position of profitability in an organization. So first, that I told you that we will be doing it in two ways. The first we have on the basis of sales. So the first three out of these, GPR, NPR and operating ratio, comes under this first category, and then all the other comes under the second category. So let us study the first category, profitability ratios based on sales. First is GPR, NPR and then operating ratio. First of all, GPR, gross profit ratio, or even it is called as gross profit margin. This ratio basically expresses the relationship between the gross profit and sales, and it can be calculated very simply by using this formula: gross profit upon net sales into 100. And net sales can be obtained by subtracting the sales return from the sales. Gross profit is also can be calculated by subtracting the cost of goods sold from the net sales. If it is not given to you, the gross profit is not directly given to you, and the cost of goods sold and the net sales are given to you, then you can simply subtract these two and find out the gross profit out of it. And this ratio is usually expressed in percentage. For that reason only you are able to see multiplied by 100 here. Let us move further. Significance of this ratio. Why is this ratio important? Because GPR indicates the average margin on the goods sold, that it shows whether the selling price that we have kept are adequate or not. It also shows the extent to which the selling prices can further be reduced without resulting in any losses. A low GPR, a low gross profit ratio, may indicate a higher cost of goods sold due to higher cost of production. It may also be due to low selling prices. A high gross profit ratio, on the other hand, indicates relatively lower cost and is a sign of good management. A gross profit ratio may be increased by taking few steps. Then next is lowering of cost of goods sold. Calculating it by lowering of cost of goods sold, selling prices can remain constant. Increasing selling prices, the cost of goods remain constant. Increase in the sale of those goods which have a higher gross margin. So basically what we are trying to do, we are trying to enhance the gross profit ratio, which can be done by any of these steps, because these are like enhancing the profits. You can lower down the cost and increase the selling prices, or you can make them remain them constant, or you can increase the selling prices and keep the cost as at constant, or on the other hand you can increase the sale of those goods which have a higher gross margin. Then further, next we have NPR, that is net profit margin. Here we have the two variations of this particular ratio: net operating ratio and net profit ratio. Net operating profit ratio basically can be calculated by dividing net sales to net operating profit. So the formula appears like this: operating profit upon net sales into 100. Net operating profit is the gross Net operating profit is the gross profit minus all operating expenses. Operating expenses consist of two basic things we know very well: administrative expenses like director's fee, legal expenses, office salaries, rent, insurance, and selling and distribution expenses like advertising, traveling expense, salaries, and commission of salesmen, etc. So, net operating profit can be calculated by subtracting the administration and selling expenses from the gross profit. Let us see further. Net operating profit, simple, net profit upon net sales into 100. So here we have the concept of net profit is different from the net operating profit, because in calculating net profit, all the operating expenses and losses like the loss on sale of old assets, provision for legal damages are also deducted, and all non-operating incomes like dividend income, interest received, and investments are added to it. So it's quite simple. When you have net profit, so you can add the net operating incomes and subtract the net operating expenses to net operating profit to obtain the net profit, or simply you can minus all the expenses and the other incomes from gross profit to obtain it. So it would depend on the question, that how the question is given to you, which expenses and which incomes are given to you. Let us have a numerical. We need to calculate gross operating profit, net operating profit ratio, and net profit ratio. We are given with net sales of 5 lakh, cost of goods sold of 3,50,000, selling expenses of 12,000, administrative expenses of 8,000, interest income of 5,000, loss on sale of old machine of 12,000. Let us see the solution. You can calculate the gross profit by subtracting the cost of goods sold from sales as 1,50,000. Net operating profit can also be calculated by subtracting the operating expenses from gross profit. No operating incomes are given to us, only the operating expenses, that is selling and administrative expenses. So we can subtract that and obtain the amount. Net profit can also be calculated further. Net operating profit that we have just calculated in the previous step by adding all the non-operating incomes and subtracting the non-operating expenses. For that, you can check out the question. Non-operating incomes, we are having interest income. We are having the interest income, and on the other part, we are having the loss on sale of old machines. So it depends on the question that what is the value that is given to us. So we have obtained all the level of profits. Now let us put them in directly into the formula. For gross profit, 1,50,000 upon the net sales into 100. Same way as net profit and net profit ratio. So you can see accordingly the ratios can be easily calculated. Let us see the significance of this ratio. The net profit ratio is actually the overall measure of a firm's ability to turn each rupee of sales into profit. It indicates the efficiency with which a business is being managed. A firm with a high net profit ratio is in an advantageous position to survive in the face of rising cost of production and falling selling prices if you are facing such a situation. So net profit ratio is, if net profit ratio is low, the firm will find it very difficult to survive in these kind of adverse situations. And in this pandemic era, we have seen that firms having a higher net profit ratio have survived, whereas the others have got shattered. Comparison of the net profit ratio with the other firms in the industry or with its previous year's results, it would help you to have a scope for improvement, and this will enable the firm to maximize its efficiency further. I have given a question here where a trading and P&L account is given to us. We can need to calculate GPR, NPR, and net profit. You can see simply the sales is 2,50,000 given to us. Gross profit is given as 1 lakh. Net profit is 42,000. Simply we can pick out the things from here and calculate it. Only the net operating profit ratio will take certain calculations, like non-operating incomes as dividend is given to us, and selling and administration expenses are here. So we will see the solution on the next slide. Simply we can calculate GPR and NPR because directly gross profit and net profit are given to us. But for net operating profit, we just need to subtract the selling and administration expenses from it, and we can find out the net operating profit, and thereby we can calculate the net operating profit ratio as well. Then next we have the operating ratio or the expenses ratio. This is also an important profitability ratio. This ratio explains the relationship between the cost of goods sold and operating expenses on one hand and net sales on the other. So the formula appears like this: cost of goods sold plus the operating expenses upon net sales into 100. So for the previous question only, we can calculate of opening stock, purchases, carriage inward, and wages are given to us. We can add all of these and subtract the closing stock from it and obtain it as 1,50,000. Operating expenses, we are having 2, selling and administration expenses, and accordingly we can calculate it. So you can have seen that 84% of the operating ratio indicates that for every 1 rupee of net sales, the operating cost is 84 paisa. So this means that the remaining 16 paisa is the operating profit for every 1 rupee of sales. So the example that we have just studied, we have seen that net operating profit ratio is 16%. So thus the operating ratio plus the net operating profit ratio gives the answer as 100%. So you can verify in this kind of situation. The significance of these one, significance, let us see. The operating ratio is actually the yardstick, is the tool to measure the efficiency with which a business is being operated. It shows the percentage of net sales that is absorbed by the cost of goods sold and operating expenses. A high operating ratio is considered unfavorable because it leaves a smaller margin of profit to meet the non-operating expenses. Whereas on the other hand, a lower operating ratio is considered to give a good sign of it. Now let us move towards the next category, that is the profitability ratios, which are based on investments. There you have the two most important ratios, that is ROI and ROE. ROI is the most important of it. You will definitely have it in exam if you are having a numerical. But it is very easy. No need to worry. Just remember the optional names, that is ROI or return on investment. Other is return on capital employed. Both mean same. So it is the most important test of profitability. We have seen that, and it measures the overall profitability. It can be calculated by comparing the profit earned and the capital or funds employed to earn it. Can be calculated using the formula PBIT, that is profit before interest and tax upon capital employed into 100. And for this purpose, the term capital employed can be computed in two ways. First is by equity share capital and adding all the other things to it. Let us see step by step. Equity share capital plus preference share capital plus any reserves and other undistributed profits if you are having. Then add the long-term loans and debentures, and from there subtract the fictitious assets and non-operating assets. In the previous lecture also we studied the same thing. Sorry. We can calculate the capital employed using the same technique. Fixed assets cost less the depreciation and adding net working capital to it. This is another way. By fixed assets, you can calculate the capital employed. The return on capital employed is dependent on two factors, that is your net profit and your capital turnover. So you can see we can obtain the formula like this: your net profit, profit upon sales, and your capital turnover, sales upon capital employed. Cancel the sales, and the answer, the formula that you're able to have, is the profit upon the capital employed. So simply you can find out your ROI. Here is a question for you. It's a balance sheet of Modi Steel Limited. Let us see how to calculate return on investment. We are given with share capital, general reserve, debentures and creditors. Here we are having fixed assets, stock, debtors and cash at bank. Net profit is given as 1,20,000 and sales is given as 10 lakh. So first of all, let us calculate the capital employed. We can take share capital, add general reserve and debentures to it, and from there we can calculate the capital employed. Alternatively, we can calculate using the fixed assets as well. We can take fixed assets, we are having two. So total 7 lakh fixed assets are there. Now let us calculate the net working capital, which can be calculated by subtracting the current liabilities from the current assets. Current assets are given as these three: stock, debtors and cash. You can subtract the current liabilities from it, that is creditors. And finally you can obtain your net working capital as 1 lakh rupees. Simply add to it and you will be able to obtain capital employed. So by both the methods we are obtaining the same amount of capital employed, that is 8 lakh rupees. Simply put the values in the formula and calculate the result. You may use this formula to verify it further or use it further to calculate the values. We know that very well, that ROI can also be calculated by multiplying the net profit ratio with the capital turnover ratio. So let us find out the net profit ratio by dividing net sales by net profit into 100, you will be able to obtain as 12%. Capital turnover ratio as sales upon capital employed, you will be able to obtain it as 1.25. So you can see, multiply the net profit ratio and the capital turnover ratio. 12% into 1.25 will come out as 15%. So you can calculate it the other ways also and verify your answer also. Then further, let us have a look to the significance and objectives. ROI is the only ratio which measures satisfactorily the overall performance of a business from the point of view of profitability. So this ratio basically indicates how well the management has utilized the funds which are supplied by the owners and creditors. In other words, you can say that this ratio is intended to measure the earning power of your business from the point of view of that earning power. It is actually very important how well the funds have been utilized. Higher the ratio is, the more efficient the management is considered to be, that they're using the funds in an efficient manner. In fact, this ratio can also be advantageously used in judging the performance efficiency of different firms in different industries. Management also uses this ratio for further decision making as well, because this gives you an idea that how the business will be prevailing. Next is return on equity. Here we have the first one under this, that is return on proprietor's equity. The formula is PBIT, that is net profit after, it's not before, it's after taxes and interest upon shareholders fund into 100. The net profit for this purpose is calculated after charging the interest on your long-term liabilities and payment of taxes. Shareholders fund is that same that we have just calculated in the previous parts, so we will be using it that way only. So here is a question to calculate it. You may check it out. If there is any problem, you may consult with me. Now the significance of this ratio, return on shareholders fund, is actually very effective measure for the profitability of an enterprise, because this ratio measures the return on the total equity of the shareholders. It should be compared with the ratios of other similar companies so that you can check out that whether the rate of return that you are providing is attractive or not. In fact, this ratio is one of the most important ratio under your financial statement analysis. So this is quite useful. Further, we have EPS, that is earning per share. We can straight away come to the formula, that is net profit after taxes minus the preference dividend, because that is something that we need to give out, divided by number of equity shares to find out the EPS. You must remember that Accounting Standard 20 mentions about EPS, then it is mandatory in nature by ICAI, because each company should show its EPS in its P&L account. Then we have dividend payout ratio, simply payout ratio. This actually indicates the percentage of your equity share earnings which is distributed as dividends to equity shareholders. So dividend payout ratio can be calculated by dividing EPS with the dividend per share. We have last two ratios here under this heading, dividend yield ratio. Dividend is declared by the company as a percentage of par value or the paid-up value of shares, but yield is calculated in the market value. You know that very well. So for that purpose, we have the dividend yield ratio. Formula as dividend per equity share upon the market price per equity share. This ratio is very important for those investors who make investment decisions for the purpose of earning a reasonable yield on the amount of investment. Then we have PE ratio, price earning ratio. This is the market price of your shares, which are expressed as multiple of EPS. So the formula appears like this: market price per equity share upon the earning per share. Let us explain this. This ratio actually gives and guides the investors to decide whether to buy the shares of a company or not. It will be clear from this example. Like suppose EPS of a company earning per share is rupees 9 and the market value of that particular share is rupees 63 per share. Then its PE ratio is 7, 63 divided by 9. In other words, the market price of every rupee of earning is 7 times here, that they will be able to get that. And a high PE ratio is actually important because it indicates the confidence of investors in earning growth of the potential of your organization. So if you face any problem, you may contact me and get your queries cleared. Do write to me if you have any queries. Till then, take care. Bye.